One quiet filing from a trillion-dollar asset titan might be enough to flip the entire XRP market from dormant to explosive. And most traders didn't even notice it happen. No giant candle, no viral tweet. Just a subtle move in the background that could change everything for XRP over the next cycle. Today, you're going to see why Franklin Templeton's early positioning around XRP-related exposure could ignite a powerful bull phase, how institutional liquidity cycles quietly build pressure long before the crowd sees anything on the chart, and the one overlooked metric that might determine whether XRP breaks out or just bleeds sideways while people lose patience and exit too early. Before we dive in, let me ask you this. Do you think institutions are already accumulating XRP quietly, or do you believe this is just another overhyped narrative? Be honest with yourself, because the way you answer that question will probably shape how you react to the next few months of price action. Drop your take because the market is about to decide which side was right in a very loud way. Here's a twist most people missed. Franklin Templeton, one of the oldest, most disciplined asset managers on the planet, has been making structural moves that hint at an appetite for digital assets beyond the usual Bitcoin and Ethereum only box. And when a conservative giant like that even leans in the direction of XRP, it tells you something deeper is shifting in the institutional mindset. Institutions don't chase hype. They don't FOMO into narratives like retail. They build frameworks, they test liquidity, they design products, and only then do they move size. What's fascinating is that this exploration from Templeton lines up with a broader tightening in crypto liquidity cycles. That's not random, that's positioning. When an asset manager with nearly a century of experience moves quietly, they're rarely guessing. Templeton doesn't telegraph without intention. Something is brewing beneath the surface. Now here's a question worth pausing on. Why does institutional entry affect XRP differently than it affects Bitcoin or Ethereum? On paper, they're all just crypto assets, right? But in practice, XRP's structure is different. Its float is structurally thin, and its main design isn't for passive holding. It's for settlement, routing, and cross-border flows. Its liquidity corridors are narrower, more specialized, and more sensitive to persistent demand. When institutions accumulate Bitcoin, spot order books usually absorb it without major structural stress because the market is used to big flows. When they start accumulating XRP in a coordinated way, entire exchange balances can tilt. In practice, a few $100 million of controlled algorithmic buying can move XRP's internal liquidity from comfortable to strained. That's a quiet lever with loud consequences if it persists. Small institutional footprints can create outsized XRP ripples. Liquidity tells the story far better than price does. Imagine this. A large institution decides they want exposure to XRP, but they're not going to open a Binance account and click Market Buy. Instead, they route their orders through OTC corridors, over-the-counter deals that operate like shadow rivers beneath the visible spot market. These flows don't create big candles. They don't light up your favorite indicator. They simply drain inventory from places most traders never look. OTC execution is designed to be boring on the surface and powerful underneath. And once that inventory runs thin, the market makers who still have to quote tight spreads start raising their internal cost of liquidity. They adjust their prices upward, little by little, just to refill the shelves. This is the shadow hinge that often appears before a major step change in price. By the time the average trader sees something happening on the chart, the real battle for supply has already been fought. Watch OTC depletion, not candles. Candles lie, flows don't. To really understand how an ETF can change things, picture a supermarket with 100 items on the shelf, but 5,000 customers outside waiting to buy when the doors open. The store has only two options. Either they raise prices aggressively, or they quietly restock from a warehouse that nobody sees, one that hopefully has much more inventory. As long as they can pull from that warehouse, the shelf looks calm and the price seems stable. But when that warehouse starts running low, everything changes. That's the ETF flow dynamic in simple terms. ETF issuers don't try to pump the price. Their job is to manufacture shares that represent the asset and get those shares into the hands of investors. To do that, they need supply, lots of it, cheap, predictable. And when they can't restock smoothly, the asset is forced to reprice higher just to shake loose new sellers. For XRP, that invisible warehouse is already smaller than people realize, and ETF issuers aren't magicians. When restocking gets difficult, prices get bold. It's not magic, it's mechanics. Here's a dual fact that surprises a lot of people. Circulating supply is not the same as accessible supply. Most of XRP's so-called circulating supply is not sitting there ready to be dumped on an ETF provider at today's price. Large chunks are locked in escrow. Other chunks are held by institutions, early whales, companies, and long-term believers who are in self-custody and emotionally anchored to much higher price levels. Many of them will not sell at $1 or $2. Some of them won't sell at $5. Some are thinking in decades, not quarters. That creates a strange paradox. On paper, XRP appears abundant. In behavior, it acts scarce. For ETF providers and big buyers, deep supply that doesn't move is almost the same as no supply. They can't access it without offering a much more attractive price. So the smart move is to track the liquid float, not the headline supply. The market moves on what's tradable today, not on what technically exists somewhere on a ledger. Here's an intriguing puzzle. If institutions really are accumulating XRP, why hasn't the price just blasted into the stratosphere already? If you only think in retail terms, you'd expect instant fireworks. But institutions buy differently. They spread their orders across time, venues, and strategies. They use algorithms specifically designed not to move price. Their goal is to harvest as much supply as possible before the market realizes what's happening. So you end up with this weird pattern. Exchange balances quietly shrinking, OTC desks talking about tight inventory, on-chain flows showing coins moving to custody, and price action that looks boring, even weak. That's not bearish by default. That's a coiled spring. Price lags now, so it can leap later. Accumulation hides itself until it doesn't. Let's compare two realities. When Bitcoin ETFs launched, they plugged into a market with deep global liquidity, massive decentralized holdings, and a culture already used to institutional flows. XRP is almost the opposite. A highly concentrated holder base, more specialized liquidity corridors, and non-linear reactions when a big player decides to tap into that pool. An XRP ETF, if fully built out and scaled, wouldn't behave like a Bitcoin ETF at all. It could act more like a lever than a sponge, small, persistent pressure, but amplified movement when the system finally adjusts. Ethereum's ETF story adds a second lesson. Regulatory clarity doesn't start the party, but it multiplies it. Once rules are clear, big pockets can deploy confidently. For XRP, ETF demand doesn't have to be huge in absolute terms. It just has to be persistent and slightly ahead of available supply. Persistence wins over time, especially in a system that's already tight. Now think about market makers. They're the invisible backbone of ETF behavior. Before an ETF product scales, market makers quietly accumulate inventory, identify where deep liquidity is hiding, and test how far they can push without breaking the system. XRP's corridors are known to be narrow and fast-moving. Some liquidity desks have reportedly spent months running small test flows, seeing how OTC, exchanges, and custodians respond to increased demand. They're mapping the river before sailing a cargo ship down it. One liquidity strategist once described XRP like this: "It behaves like a narrow river, beautiful to navigate when it's calm, but dangerously fast when you add too much volume." When market makers prepare cautiously, it's usually because they see both risk and opportunity. Risk precedes movement. Volatility is often the price of recalibration. If you're finding value in understanding how these institutional mechanics really work and not just staring at daily candles, make sure you subscribe and stick around. We follow the flows, not the hype. And in crypto, flows are where the story truly begins. Now, here's the hidden twist. XRP outflow patterns from exchanges have been rising sharply over recent weeks and months, even in periods when price action looks flat or slightly depressed. That disconnect confuses a lot of traders. Most people assume heavy outflows mean panic selling, but in this case, the opposite is more likely true. Exchange to custody flows are the classic signature of long-term accumulation. It means coins are being taken off trading venues and moved into wallets where the intention is to hold, not flip. Balances drop, while the number of non-exchange wallets holding meaningful amounts of XRP grows. That's not a fear pattern. That's a conviction pattern. Follow the balance drop, not the red candles. The truth is often hiding in the outflow chart, not the price chart. Imagine a marketplace where there are only a handful of items left on the shelf. Buyers start to get nervous. Some try to grab anything they can. Sellers, on the other hand, become more confident. Each decision starts to carry more weight. Every purchase moves the needle. That's what thin liquidity feels like. It amplifies emotion and multiplies the impact of even small headlines. If Franklin Templeton and other institutional players are quietly draining supply from the system, the market becomes primed for overreaction. A small piece of good news can trigger outsized upside moves. A minor scare can cause violent dips until buyers realize there's still not much available and rush back in. Thin liquidity turns small news into big waves. The tension itself becomes part of the momentum. When we look at Ripple's role in this ecosystem, it's easy to fall into old narratives about selling. But the last several years tell a much more nuanced story. Ripple has gradually shifted from heavy, open market distribution toward more disciplined, corridor-focused, and institutional allocation. They've been under legal and regulatory pressure, which forced a smarter, more strategic approach. That reality actually aligns with what ETF structures need: predictable, measured, and professional liquidity, not random fire hose selling. Ripple executives have talked repeatedly about optimizing corridors, ensuring there's enough XRP where it's needed for payments, rather than just dumping to whoever pays. That discipline, while frustrating for some short-term speculators, is a quiet, bullish signal for long-term credibility. Ripple's restraint is an asset, not a bug. Discipline builds trust, and trust is what institutions shop for. Here's a future dynamic almost nobody in retail talks about: ETF arbitrage. When an ETF share drifts above or below the price of the underlying XRP, market makers have a built-in incentive to rebalance. If the ETF premium rises, they can create ETF shares by buying XRP, pushing spot demand. If the ETF trades at a discount, they can buy the ETF and redeem for XRP. The narrower and thinner the liquidity band, the faster this arbitrage snaps prices back into line, sometimes with sharp, sudden moves. In XRP's case, where the liquid float is not as deep as people think, ETF arbitrage could amplify volatility on both sides. A modest net inflow could trigger aggressive spot buying. A rapid outflow could do the opposite. Arbitrage doesn't care about your bags. It just follows the math. It adds fuel to whichever direction dominates that day. Balance brings movement, not stillness. Now back to Franklin Templeton. This isn't just another asset manager jumping into crypto for clout. Their entire history is built on spotting long-wave macro cycles early. Regions, sectors, and asset classes that are misunderstood or underpriced relative to their future role in the global system. When they show up in a space, it's rarely about a quick trade. It's about building scaffolding for multi-year exposure. Their interest in digital assets and any exploration related to XRP's ecosystem fits that pattern. Templeton doesn't sprint after short-term upside. They try to anticipate what will feel inevitable 5 or 10 years from now. So when a player like that even explores XRP's potential, it should make you ask a simple question. What are they seeing in terms of utility, settlement, and tokenization that most retail traders are ignoring? Their timing, historically, has often spoken louder than any marketing campaign. There's another overlooked angle here. XRP isn't just a speculative ticket, it's a settlement tool. In real-world implementations, XRP can sit at the center of cross-border payment flows, acting as a neutral bridge asset between currencies and systems. Now imagine that settlement layer quietly interacting with an ETF layer built on top. When institutions use XRP for cross-border flows, they add a second source of organic demand. That settlement demand can collide with investment demand from ETF holders and traders. Few crypto assets have that dual utility profile at scale. When utility and investment align on the same rails, price doesn't just drift, it accelerates. Two engines, one direction. If you look back at XRP's history, most of its major bull runs share the same pattern. Long stretches of boredom, months where nothing seems to move. Sentiment becomes cynical, attention wanders, and people start declaring the asset dead. And then, almost out of nowhere, price goes vertical in a shock move that ruins both the late bears and the early quitters. This is the delayed fuse effect. Pressure builds slowly while the market shrugs, until the fuse finally catches. Templeton's positioning and the broader institutional interest could be the spark that lights the next one. But it won't feel exciting at first. It will feel like nothing is happening. XRP moves slowly until it doesn't. Compression creates velocity. The longer the coil, the sharper the snap. Retail traders often misread these quiet phases. Low volatility is interpreted as weakness, or as a sign that nothing is going on. In reality, low volatility environments are where institutions do their best work. They can build positions without attracting attention. They can test systems without triggering social media hysteria. The biggest mistake retail makes is leaving right before structure is fully formed. In XRP's story, the calmest stretches on the chart have repeatedly come just before the sharpest breakouts. Quiet markets are hungry markets. Stillness hides strength. If you only judge an asset by noise, you'll miss the signal every time. Now take a snapshot of today's liquidity map. You see decentralized liquidity slowly rising, centralized exchange reserves trending downward, OTC desks reporting tighter conditions, ETF issuers sniffing around for scalable exposure, market makers quietly adjusting their risk models and inventory levels. All of these are small hints, but together, they form the anatomy of a market preparing for a structural shift. The next phase for XRP is unlikely to be driven by meme coins or random retail narratives. It will hinge on sustained accumulation, regulatory clarity, and real-world integration into settlement and tokenization infrastructure. Liquidity flows reveal the future before price does. If you want to be early, you don't watch headlines. You watch where the liquidity is going. Here's the long-wave insight most people never zoom out far enough to see. XRP isn't just trading inside another speculative altcoin cycle. It's slowly migrating toward the category of institutional-grade infrastructure. Assets and networks that sit under the hood of cross-border payments, tokenized securities, and real-time settlement systems. When an asset makes that transition from narrative-driven to infrastructure-driven, its volatility profile changes, but its upside doesn't just vanish. It evolves. Templeton's involvement, alongside other institutional exploration, is part of a broader multi-year shift toward tokenized finance, programmable money, and digital collateral. XRP is being repositioned from hype to plumbing, from storyline to spine. And here's the thing about infrastructure. People stop talking about it every day, but it quietly powers everything. Infrastructure endures. So what does all this mean for you? Sitting there, watching XRPUSD, and wondering if you should care about another so-called institutional narrative? Franklin Templeton's quiet moves are not random. Exchange balances keep dropping. On-chain flows show coins moving into stronger hands. Liquidity corridors are tightening at the same time ETF structures and digital asset regulations are evolving. If this pressure continues, the next big move in XRP may not be sparked by retail hype, but by engineered institutional demand colliding with a structurally thin float. And when that happens, the chart won't ask for your permission first. Stay tuned because this story is still in its early chapters, and the most important moves usually happen before the crowd even realizes there's a new game being played. Not professional advice. Consult a qualified expert as needed.